So we are starting to discuss this question, the name of which is Spine Company. Let's start discussing this. When we talk about the Spine Company, the Spine Company question is that it says Spine Company is looking to spend $15 million to expand its existing business. The expansion is expected to increase profit before interest and tax by 20%. Recent financial information relating to Spine Company can be summarized as follows. Now, what does it say? It says profit before interest and tax, finance charges, profit before tax, taxation, so and so, so and so, so and so. Now, it says evaluate whether on the financial ground. Evaluate whether on the financial ground, Spine Company should finance the expansion with debt or with equity. Okay, now see. So what actually happens is that we need to evaluate on the financial ground whether the finance should be with the debt or should be with the equity. Now let's just try to see that what is going to be the impact on the different KPIs, on the different ratios when you'll be financing by debt, when you'll be financing by equity. So let's just try to see this. Because you see what happens is that as an investor, you would want to see that what is going to be the maximum return, what is going to be the maximum gain that we are going to get with respect to it. So let's try to see this. See, one of them is that in case if funding is done using the debt finance. So if the funding is done using the debt finance, how exactly are you going to do it? You're going to say, number one, is that profit before interest and tax. This is the existing profit before interest and tax, 13040. It will be increased by 20%. Existing, this is revised. This will increase by 20%. The interest expense, you would have this existing cost, which is 240. The additional cost, so you'll end up getting the profit before interest and tax. Right? You'll end up getting the profit before interest and tax. So this is going to remain 240. And this cost is going to be, you'll spend $15 million. So you will raise the finance with 15% of 8% loan note, 15 million, 8% loan note. So it is actually going to be 15 million means 15,000 into 8%. 15 into 10 raised to power 6 divided by 1000 multiplied by 8%. So this is how it is going to be. The 1200 is going to be the finance cost. Plus what is going to happen is that you would have this taxation impact. There's going to be the taxation impact. Profit before interest and tax is there. The taxation at the rate of, what was the tax rate given in the question? It was 30%. Hence, the profit after tax is gonna be is gonna be 9945.6, right? Profit after tax is gonna be 9945.6. Now, when you will have this profit after tax, so now what do we need to do? We have the existing share price given to us. Okay. The PE ratio, which is the existing P ratio. P ratio formula is share price divided by EPS, right? What is the number of shares that we have right now? 12 million shares. Share price, EPS. Share price is 6.25. The EPS is 8960 divided by 12,000. This is what the EPS is. So the revised PE ratio is going to be 8.37 times. The P ratio is going to be 8.37 times. Now, what happens is that what we are going to do is that we are going to use this revise. The P ratio remains the same, 8.37. The EPS is going to be what? The EPS is going to be this divided by 12,000. The share price is going to be this multiplied by this, gives you 6.9375. Gives you 6.9375. So the increase in shareholder wealth will be this minus this multiplied by 12,000. So increase in the shareholder wealth is going to be 8250,000. 8250,000. So the increase in shareholder wealth is going to be 8250,000. That's what it is going to be. Now let's just try to see that what's going to happen with respect to if funding is done using the equity finance. Let's just try to see what's going to happen. If funding done using equity finance. If the funding is done using equity finance, what's going to happen? Let's try to understand that. So the profit will increase, the interest expense will be unchanged, right? The profit before interest and tax is this, profit after tax is this. The EPS ratio is this. Now what happens is that over here, what's going to happen? Now see, the number of shares that will be issued. We got to see the number of shares that actually need to be issued. There is going to be a right issue of 144 right issue. So the revised number of share is going to be this. The theoretical X right price will be how much? 4 shares. 4 shares at a price of 6.25. 1 share at a price of 6.25 into 20% discount. Hence, resultingly, what happens is this into this into this, $30. The theoretical X right price is going to be this divided by 5 as 6. Now, what else is there? The P ratio would remain the same. The EPS might actually become this divided by. So the share price might become this into this, 6.01875. Here it is 6. So I would actually take a higher price and I would say that gain in shareholder wealth is gonna be, let's say, let's say this multiplied by 15,000 minus this multiplied by 12,000. So 15281.3. 15281.3. How did we get it? It's basically like this price, the revised price multiplied by the number of shares minus this price multiplied by the number of shares. Now it's basically 15281. That's how technically it is. So that's what the gain is going to be. Here the gain was this. So based on the financial grounds, the issue of right shares is a feasible option as it would lead to a greater increase in the shareholder wealth. Now let me just do the discussion again. Did you people get to see this one earlier? Did you get to see this one earlier? Yeah, did you get to see this one earlier? Okay, can you just see now? This is basically on the basis of debt funding. Now, so basically with respect to this, we have this additional cost, this additional amount. Plus what happens is that we have used the same P ratio to calculate this. Right? Okay. Now, so the increase in the shareholder wealth is going to be like this. The difference between the revised price and the earlier price minus multiply the number of shares. Now, if equity finance is used, this is what the revised situation is going to be. Just look at this part. I will pick up the other part also. Now look at this remaining part. Now let's move a bit forward and let's discuss further. The next aspect of this question is that it says that explain and discuss the relationship between the systematic risk and the unsystematic risk. Now let me just explain to you a few pointers with respect to the difference between systematic and unsystematic risk. The difference between systematic and unsystematic risk, let me just tell you the difference. See, what actually happens is that the number one thing is that you need to understand, which is there is a portfolio theory which says as you grow the number of investments, the risk gets diversified away. That is, if you invest money in a single sector slash industry slash company, there will be a very high risk. However, if the money is invested into multiple businesses, then the risk reduces due to greater number of investments. The risk in one sector is offsetted by the returns in another sector. So the concept of systematic, of unsystematic risk is that this risk is diversified away with the increase in the number of investments. So once the entity keeps on increasing the portfolio with diverse investments, the risk keeps on reducing. There comes a time when the risk stops reducing further. This risk which remains is termed as systematic risk, and it cannot be diversified away. So get my point. It cannot be diversified away. It's called systematic risk and it just cannot be diversified away. So that's what is the difference between the systematic and the unsystematic risk. Now the last part of the question is that discuss the assumptions made by CAPM. So when I talk about the assumptions made by CAPM, so there are multiple assumptions. 1, 2, 3, 4. The number one of them is that the investors hold diversified portfolio. The perfect capital market exists. The borrowing and lending is performed at risk-free rate. So borrowing and lending is performed at single risk-free rate. All returns are based on single period. All returns are based on single period. So that's what it is all about. That's what it is all about. So basically this was the question, the name of which was a spine company, and the question what it did was it was actually based upon the concept that the question was majorly based upon the concept that um, what is going to be the impact on the value of the shares of these different things, right? So I hope that you people did understand and enjoyed the session and that the things were clearer to you now.